Hi everyone, welcome back to the podcast. Today we're joined by Dhruv Sane of Malpani Ventures. Dhruv writes a Substack as well, which I just recently discovered as I was preparing for this podcast today, and I found it to be a gold mine for founders and people who want to aspire to be in VC and keep up with the happenings of the Indian VC ecosystem. And also kudos on your promotion to principal at Malpani Ventures. Dhruv, let's get into what was your journey and path like to VC and Malpani Ventures. Like, how did that opportunity materialize? And yeah, let's just talk through the Malpani Ventures side of things to start with.
Sure, sure. Thank you so much for having me, Roohi, first of all. And thank you for the kind words about the Substack as well, right? What we try to do is just share some of our learnings with the broader ecosystem, right? Coming to my journey, I am a CA and a CFA. So I started my career with Deloitte in their forensic team, where I actually looked for, accounting frauds at large companies. I worked there for about 3 years. Decided I wanted to get into more of finance. Hence moved to a mid-market investment bank called Lola Capital. Was with them for about 3 years, and then got the opportunity to join Malpani Ventures. I've been with them now for the last 3 plus years, and yes, it's been quite a journey. To give context to some of your listeners on Malpani Ventures, we are essentially a single family office. We manage private investments for Dr. Anirudh Malpani, who has been a prolific angel investor himself. Right? What we typically tend to do is we come in fairly early at the pre-seed stage, and then back companies with patient capital.
Yeah, so you've had an impressive journey, impressive track record, and your writings are just absolutely amazing for anybody wanting to get into the space. And so my next question is, so let's just riff on that a bit. Like talk us through like more on this patient capital concept. Like what do you mean by patient capital and like what can founders expect when they have a meeting with you or have a meeting with Dr. Anirudh or anyone on the team?
Right, right. No, I think this is a very pertinent point, Roohi, and probably under discussed, right, within the VC ecosystem, right? So, what we mean by patient capital is typically early stage startups, right? The first thing that they are looking to do is get to PMF, right, product market fit, right? And at that stage, you typically want an investor who's not going to put pressure on you in terms of both scale and the time you take to raise your next round, right? uh, Research shows that typically getting to PMF can take anywhere between 12 to 18 months, right? And some of the more famous companies have actually taken longer to get to the right product market fit, right? So the early stage is where you really want an investor who will who's with you and understands that the business is really taking form, right? And is not really pushing you to show revenue, or not really pushing you to raise your next round so he can get his uptick that he can show to his LPs, right? So what we mean by patient capital is that all of our capital is proprietary capital. We have a single LP. We do not have to report to hundreds of people about the happenings in a company. So that essentially gives the founder breathing space to sort of experiment, iterate, and work around and find the right channel, right, to get to market, right? I think that is really crucial to building the right fundamentals for a business, right? So that's what we mean when we say we provide patient capital.
Yeah, that's a super interesting approach to kind of allocating capital, and it's really interesting that you're only backed by one single LP, and whereas most VC funds out there have like hundreds of LPs, small and big, small check sizes, big check sizes, and the works. Let's riff on like PMF a bit. So let's talk through like curious how can startup founders find PMF in different kinds of markets and conditions, and kind of what are some of your contrarian thoughts on that as well, like any differing views you have on that topic, like curious to know your insights and your stories on that.
Sure, sure. I think PMF is has been discussed several times over. so I'm not sure if I'll have anything substantial to add. I simply define PMF as a profitable and repeatable method of getting to market, right, with your product or service, right? So let me break that down a bit, right? What tends to happen, right, when you get VC money is that you chase revenue, right, and then you're not really bothered about, your contribution margins, right? Because you want to show that top line, right? So for me, that is not true PMF, right? Because I am including that you have to be profitable in that channel, right? Or that market to be able to call your startup PMF ready, right? So my contrarian take will be is that that it takes time, which is something that not some of my peers will share with me, right? So what I firmly believe is that if you're building a business from grounds up, it takes time for a founder to really understand, because the founders are humans after all, right? You can't expect them to build, you can't expect them to market, you can't expect them to sell within a constrained period of time, just because your VC fund life doesn't allow you to give them more time, right? So my view is that it takes time, right? And that you need to really figure out a way and be honest with yourself, right? Whether this channel and this market is the right fit for me, and I can serve it in a profitable manner repeatedly, right? So that's how I would define PMF to me.
Yeah, I think that was a really interesting point you've made. And let's talk in more about what are some of the metrics that founders should be chasing instead of like the revenues and stuff like that, or what the top line or whatever you were discussing at the beginning of the question. First, the previous question.
Sure. So I think this, it will be difficult to give a very generalized answer here. I think what I would look for is, obviously rate of growth is important, but more importantly, are the margins over time, right? So you look at gross margins, you look at contribution margins, you look at your cash burn, right? So I think at the very beginning for a startup, I think these three or four metrics, where you look at your top line, you look at your margins and your burn. Now this is a very simplistic answer, but uh, people tend to shy away from the latter 2 points that I mentioned, right, while focusing on the first, right? So I would say that a holistic view of all three is essential, right? And obviously you need to break that down further. With if you're a SaaS business, then you have to look at recurring revenues. If you're a consumer business, you need to look at CAC, right? So now the nuance plays into this, but I'm giving you a very a simplistic answer or a simplistic framework right now.
Yeah, I think that was a solid framework. And so my next question is more like along the lines of a Substack article you wrote on basically fixing the broken Indian startup VC ecosystem for early stage funding. So, what are some of your thoughts or insights on how this can be fixed, and like, what could you share with the audience today on like how this can be done?
Yes, yes. No, so I think I am referring to the very same point that I made, right, about patient capital. So what my belief is that at the very early stage, right, especially at the pre-seed stage, you need investors who will give you the time to iterate and play around and find the right business market fit, right, for your business. Uh, what I meant in that article was that a VC is constrained by its fund life, right, and by the need to show an up round within a certain period of time, right? If you don't do that, then you are sort of not very important for that VC, right? So it is important for the founder to realize at what stage, right? I am all for raising VC money, right? I don't want to make it sound that I'm against it, right? I am arguing for is the time, right? Is that the founder needs to get the timing right for raising VC money, right? You want to use VC money to in sales and marketing, right, and not in your R&D or not in your ideation, right? Now, this is a very generalistic take. Now, there can be cases where if you're building something, say, a robotics startup or a satellite based startup, right, you will need the money for R&D, right? But I'm saying for most businesses, you should not be using VC money to sort of ideate your product, right? There are, there are examples of companies who've done well by this method, but they are the exceptions and they're not the rule, right? So what tends to happen is that you uh, because you've raised a VC round, typically what I've seen is that founders will take a subpar product to the market, right? And then realize that they don't, that there aren't any takers, right? Or they'll tend to buy revenue, by spending or by giving abnormal discounts, right? And when you have a funding winter like we did recently, then that's when the chicken come home to roost, right? And then that's when you realize that, hey, did I really have a business in the first place, right? So what I'm arguing for is that founders need to realize what kind of capital they need to seek, and at what stage of a business demands VC money, right? So that is something that needs more consideration, in my view.
Yeah, I think that was a really good point. And so my next question is like, so you discussed a bit about like some companies that have like raised VC funding. Like you didn't give many examples though. So what are some of these successful Indian companies who have raised VC funding, and like what are some companies that have bootstrapped and become large without VC funding in India? And so like, could you just share your thoughts and views on that as well?
Sure, sure. So I think the measure of success for a VC-backed company has to be an IPO, right? And sustained performance on the markets post IPO as well, right? You will have examples of strategic buyouts and M&As giving liquidity to VCs, but as a founder, you really want to take your company to a successful IPO, right, and continue to run the business, right? So, for me, the measure of success is IPO listing and then sustained performance on the market, right? So to that end, I think now we have several examples that have done well, right? So for me, good VC-backed startups would be the likes of Zomato, uh, IndiaMart, RateGain. All of them have done well for their initial set of investors, plus have performed well on the stock markets as well. There are smaller IPOs which don't get mentioned often, right? And there are good outcomes for VCs there as well, right? You have the SME platform for listing as well, and you have some of these smaller companies who have actually done well post their listing, right? The likes of a E2E networks or the likes of a Zaggle. I think they've done really well post their listing, right? On the bootstrap side of things, I think there are not too many, but there are enough examples as well, right? You have the likes of a Zoho, which has built really an India for the world software business. You have the likes of a Zerodha, which has really outcompeted incumbents in its space. So so my point is that you have enough examples on both sides of the spectrum, right? I think you can build businesses in a bootstrap manner as well. And I personally don't like this dichotomy, right? You're calling a business VC funded or bootstrap, right? I think ultimately a business is a business, right? At the end of the day, the goal of a business is to maximize enterprise value, right? With limited dilution, right? So you can do it with VC money or without VC money, right? So I think what's crucial to understand is that uh, the founder understands the trade-offs involved, right, in both these in both these methods. But today, thankfully, we have enough examples across both ends of the spectrum.
Yeah, so my next question is, what would it take to get to the next Zomato or the next IPO situation for VC funded companies or just for any businesses in general?
Yeah, I think I think most companies have now realize that profitability or a path to profitability is what the markets demand, right? At least the Indian stock markets demand it. So and sustainable ROCs or ROEs in the long term, right? So what we are witnessing right now is a lot of companies shedding away their excess baggage, right, and cleaning up their financials to be ready for IPO, right. So I do foresee that the next 3 to 5 years, and there have been so many IPOs in the last 6 months as well, because the market conditions are favoring new companies to list, right. But I think this is a good change, right? Where now founders are realizing that we need to get to a certain steady state of revenues with good profits, right, and a path to expand margins over time, right. So I think we are getting there.
It's so great that you have such optimism for the IPO market, and like, let's just dive deep into like some questions that people had from X to wrap up this conversation. And so the first question came from someone on X, and he was mainly asking, so how do you identify founders who can be trusted to be frugal after fundraise? And given that Malpani Ventures, like the whole investment thesis is to fund frugal innovation in like India, so how does that exactly happen, and like what are the checklists or like benchmarks that you have to that like enable you to trust these founders?
Sure. I think this is a very good question, Rohi. So what I want to clarify is that when we say we want to back frugal founders, is that we're not saying that we want the founders to cut corners or not pay their employees well, right? What we are really saying is that we found the founder to be capital efficient, right? What I mean by that is that we want the founder to think about our capital as his own money, right, and not mindlessly spend the money off in sales and marketing budgets, right, which is what we saw during the ZERP era. Right. So, how do we identify such founders? So I think there are several soft cues that we are looking for when we interact with founders, and there are some hard cues as well, right? You look at if there is some existing data that you have for the company or for the startup, you look at how the company has been in terms of its capital efficiency, in terms of managing its working capital. You get a sense of are they managing more with the same amount of capital versus uh, other peers in that area. So I mean there is no single answer, because every sector will have its own its own sort of asks. But what we are essentially hoping for is the founders who are not necessarily looking to mindlessly accelerate, right, but rather looking to sustainably build businesses for the long term, right, and what we view ourselves are as long term investors, right, or we view ourselves as part-time business owners. So we want founders who want to own that business for a very long time, right, and if you have that mindset, then automatically you become frugal about the capital you have in the business.
That's a great way to look at it, and I really think that this framework and this checklist that you shared will help a lot of aspiring founders who are looking to kind of fundraise or get in touch with Malpani Ventures. And so, my next question and my kind of last question for you today is, how have your views of the ecosystem? This is also from somebody on X. So, how have your views of the Indian VC ecosystem changed from your mid-market IB days to kind of now where you're at Malpani Ventures? You've been here for about 3-4 years now. So how have your views kind of changed of the Indian startup ecosystem? And then adding to that, Like, what do you think Indian startup ecosystem and Indian VC ecosystem could take from other ecosystems like Silicon Valley and the other ecosystems that are out there?
Yeah, yeah. So I think what has changed for the better is the democratization of capital. I think we have lots more capital today versus 5 years, 10 years back for a broader or a diverse audience of founders, right? You have money now going into pure hardware startups, into drone companies, right, and into energy companies, into areas that you would not think that capital would flow to. 5 years or 10 years back, right? So I think that is a very welcome change in my view, and I think we should constantly look to expand our horizon, right, for VC there. Um, in terms of what we can take from some of the other ecosystem systems is just the level of transparency and the fact that they are so open about sharing their insights, right? Both founders and VCs, in terms of their understanding of the market, in terms of their GTM strategies, right? Uh, I think we lack that here in India, right? And what we've done is simply copy a lot of Silicon Valley playbooks, right, to build businesses in India. I think what we need is founders who have actually built businesses in India to share some of their learnings, right, and share them widely. I think that is what we truly need to sort of build an indigenous knowledge bank, right, of some sorts for a VC playbook in India. So that would be my wish for the Indian ecosystem.
Yeah, I think that's kind of happening with these various events that are going on pan India. Like when I was in Bangalore, like I attended like a ton of events as well, and there's a lot of knowledge sharing going on from founders and stuff that I was attending. And so I think that should also be widely shared. It shouldn't just be restricted to the people that are there offline, but there should be a way to get more people involved in it online and just kind of having a more knowledge sharing ecosystem.
Absolutely, absolutely. I absolutely second that.
So yeah, it was an absolute pleasure and an honor to host you on the podcast today. And like, do share how the audience can get in touch, how they can pitch, anything that you want to share. Like, now's your stage.
Sure, sure. Thank you so much for having me, Roohi. Anyone who wants to get in touch with me, I'm on LinkedIn, I'm on Twitter. I write a Substack called The Same View. So you can reach out to me on via any of these mechanisms. My email is available on my LinkedIn profile at Dhruv Sane. So happy to always talk to more